5 ways to measure and analyze market sentiment. Market sentiment is the overall attitude or feeling that investors have about a particular market or asset. It is often described as a collective mood, emotion, or tone of a market. Market sentiment can have a significant impact on financial markets, therefore it is critical for investors, traders, and other market participants to understand the overall mood of the market because it can impact the supply and demand of an asset or market. With complete understanding of market sentiment, investors and traders can make better informed decisions about when to buy or sell assets. When sentiment is positive, traders tend to be optimistic about the future prospects of an asset or market, which can lead to increased buying activity and higher prices. This can create a self-reinforcing cycle, where rising prices lead to even more positive sentiment, and vice versa. Positive market sentiment can lead to increased buying activity, higher prices, and bullish trends. When sentiment is negative, traders tend to be pessimistic about the future prospects of an asset or market, which can lead to increased selling activity and lower prices. This can also create a self-reinforcing cycle, where falling prices lead to even more negative sentiment, even lower prices, and bearish trends. It is worth noting that market sentiment is just one of many factors that can influence financial markets. Other factors, such as economic fundamentals, geopolitical events, and company-specific news, can also impact prices and trends. Just a quick reminder to please destroy the like button and hit the subscribe button. Also, visit us at www.investmenttees.com and use code BLOG to receive 25% on your next purchase. Market sentiment can be measured in a number of ways. Some of the most popular sentiment indicators used to measure the overall mood of the market are: 1. The Chicago Board Options Exchange VIX Index. The Chicago Board Options Exchange, or CBOE VIX, short for the VIX, or the CBOE Volatility Index, is a sentiment indicator. The CBOE VIX Index is a measure of the expected volatility of the S&P 500 index, which is a stock market index based on the stock prices of 500 large companies listed on stock exchanges in the United States. The VIX index is also known as the fear index because it tends to increase when the stock market experiences high levels of uncertainty or risk. Traders and investors use the VIX index as a way to gauge market sentiment and make decisions about risk management and portfolio allocation. 2. The American Association of Individual Investors Sentiment Survey. Another market sentiment indicator is the American Association of Individual Investors Sentiment Survey, AAII for short. The AAII Sentiment Survey is a weekly survey that measures the sentiment of individual investors towards the stock market. The survey asks participants whether they feel bullish, bearish, or neutral about the stock market's short-term direction, as well as their expectations for the stock market over the next 6 months. The results of the survey are often used as a contrarian indicator, meaning that extreme levels of bullishness or bearishness among individual investors can signal a potential trend reversal in the stock market. The AAII Sentiment Survey is one of the most widely followed sentiment surveys in the financial industry. 3. The put-call ratio. Another market sentiment indicators is the put-call ratio. Put-call ratios are a measure of market sentiment and activity in the options market. The put-call ratio compares the trading volume of put options to call options on a particular underlying asset, such as a stock or an index. A put-call ratio above 1 indicates that more traders are buying put options than call options, which suggests a bearish sentiment in the market. Conversely, a put-call ratio below 1 indicates that more traders are buying call options than put options, which suggests a bullish sentiment in the market. Put-call ratios can also be used to gauge market activity, with high put-call ratios indicating high levels of market activity and low put-call ratios indicating low levels of market activity. 4. The advanced decline line. The advanced decline line is a technical indicator used to measure the breadth of market participation in an index or exchange. It compares the number of advancing stocks, example, those whose prices have increased from the previous day's close, to the number of declining stocks, example, those whose prices have decreased from the previous day's close on a given trading day. To calculate the advanced decline line, you take the difference between the number of advancing stocks and the number of declining stocks and add it to a running total from the previous day. This produces a cumulative line that can provide insight into the strength of a market trend. A rising advanced decline line indicates that a large number of stocks are participating in an upward trend, which can be seen as a bullish signal. Conversely, a falling advanced decline line indicates that a large number of stocks are participating in a downward trend, which can be seen as a bearish signal. 5. The ARMS Index Indicator. The ARMS Index, also known as the Trend Short for Trading Index, is a technical indicator used to measure the strength of market trends by comparing the ratio of advancing stocks to declining stocks with the ratio of advancing volume to declining volume. It was developed by Richard Arms in the 1960s. The Arms Index is calculated by dividing the ratio of advancing stocks to declining stocks by the ratio of advancing volume to declining volume. A reading above 1 is generally considered bearish, indicating that selling pressure is higher than buying pressure. Conversely, a reading below 1 is generally considered bullish, indicating that buying pressure is higher than selling pressure. Traders and investors use the Arms Index to help identify potential changes in market trends and make decisions about their trading strategies. The Arms Index is particularly useful in volatile markets where there may be large discrepancies between the number of advancing and declining stocks and the volume behind those moves. One popular strategy is contrarian investing, which involves taking positions opposite to prevailing market sentiment. For example, if the market is experiencing extremely negative sentiment, a contrarian investor may look for opportunities to buy assets at discounted prices, betting that sentiment will eventually shift. Conclusion: market sentiment is a critical component of financial markets. Understanding how it works, how to measure it, and how to use it in investment strategies can help investors make informed decisions and potentially generate significant returns. All of these market sentiment tools can provide valuable insights into market sentiment and help investors make informed decisions. While market sentiment is just one of many factors that can influence financial markets, it is an important one that should not be overlooked. Thank you for watching.